Hello guys, so I was just pondering upon something that despite a repo rate reduction to the extent of 1.5%, the same has not been priced into the 10-year bond yield in India, right? But now I certainly believe, right, that the bond yield will get repriced to the extent of the repo rate reduction, and the 10-year bond yield should come below 6.5%. Right, it still stands closer to like 6.5% or like above 6.5% to that extent, but now it should definitely come down. The reason is our fiscal deficit is coming down, right? I understand that during the GST, right, the GST rationalization, there was a huge expectation that since more money is getting out of the pockets of the government and the people shall be purchasing more of the consumer goods and services due to the account of the GST rationalization into two slabs, the money left with the government of India will be less and hence the borrowings will be more. But one thing here that we tend to forget is, or we do not understand is right, whatever cess, right, the central government has collected over the past 1 year, right, 1 year or 2 years, it has gone towards the payment of its government debt, right? So instead of going in the different parts of India, it has completely gone towards the payment of the government debt. So now the balance sheet has been improving. The balance sheet is becoming much more cleaner. So the fiscal deficit will not rise. The point of cess is very important here, that where this cess was utilized, it was utilized in paying off the government debt. So hence, we can achieve our fiscal deficit target as a percentage of GDP. So as of today, we stand closer to somewhere like 4.5%, like 4.4%. We can come to a target closer to like 4.2% odd, right? And there is something called as like fiscal consolidation, right? And the problem for twin deficits, that is the current account deficit and the fiscal account deficit. Talking about the fiscal drag or the fiscal consolidation, as we aim to reduce our fiscal deficit, and we have been trying to reduce it from a past couple of years. In the FY24, we reduced it to around like 130 basis points, by 130 basis points. In FY24 by some 75 to 80 basis points. In FY27, it's expected to go down by some 30 basis points, right? Now here we can argue that for a high growing country, or if a country wants to grow, the fiscal deficit needs to be high. And if the country is not growing, the fiscal deficit will be low because the government is not doing borrowings to fund the expenditure and doing like different kind of activities to stimulate the economy. But there's also like one more angle towards looking at it, right? Even if we can grow at a very high rate, at more than 10%, like 11% odd, in the subsequent 1-2 years, the current GDP print being like closer to like 6.5% to 7%. Adding the average inflation that remains between like 4.5% to 5%. So if we can grow at somewhere like 11.5% to 12%, which coincides with the long-term growth of the Indian economy, and the fiscal deficit can come down, then why not, right? The second thing is about the current account deficit, right? The current account deficit came down. It's again projected to increase to 1.3% of GDP from a 0.7% to the percentage of the GDP. Right, on account of the trade deficits, right? Because of the US tariffs, our exports have been hindered, our exports have been impacted per se. And as a result, we aren't able to export more, right? But here the problem of the currency depreciation also comes into place. The fact is that in a growing economy, right, if we want to encourage our exports, because a growing economy has to work upon exports. If we try to compare ourselves with China, China had been growing for like 15-20 years, right, at a GDP growth rate of more than 10%. Why the exports? Because China used to export a lot. It used to manufacture stuff into China, or maybe dump it or export it to the other parts of the world. So if a country wants to grow, it has to stimulate exports. And as a result, China used to devalue its currency deliberately to stimulate the exports, right? So even if the INR is coming down, again, that's a healthy sign, I believe, because every emerging economy faces currency depreciation or currency devaluation to stimulate exports. So we need to take the advantage of this situation and work upon our exports. There's one metric in terms of currency connotation that is called as real effective exchange rate, RERR, that compares our currency with the basket of the other currencies on a trade basis, on a trade relative basis. As of now, in terms of RERR, they stand somewhere closer to like 97, 98. So INR has been extensively overvalued in the previous 1-2 years, but now it is coming back to its fair value. Because even before, at the time of our previous RBI governor, Mr. Das, whenever the INR used to fall, we used to sell off our FX reserves, like sell off the USD and purchase the INR to stabilize the INR purchase. And again, that also overvalued the currency fundamentally. But at this particular point of time, when the INR even crossed 91, our new RBI governor, Mr. Sanjay Malhotra, they did intervene. The FX reserves need to be preserved, right? Because at one point of time, we also know that the US tariffs are there. वो कब solve होगा, कब नहीं solve होगा, भाई किसी को नहीं पता. We have to live with the geopolitical tensions now, as it seems. Right? We have to stimulate our exports, and for that, the currency has to come fundamentally to a reasonable level. Not overvaluation, not undervaluation of the currency, but fundamentally at a reasonable level to stimulate the exports. And that is something which is happening in the economy. Also, one more thing I will tell you, that why the interest rates should further come down is, the government has stopped the refinancing of long tenure bonds. The long tenure T-bills, not T-bills, but T-bonds. Right, the average maturity or the average duration per se, right, of a government T-bill used to be 20 years. But now it has come down to 12.5 years, closer to 13 years, right? At the time of 2013 in taper tantrum, right, it was decided by the government of India or the RBI per se in terms of the central bank authority that they shall be refinancing long-term bonds because short-term financing might be costly. Right, but now they have come down because excess of like everything is bad and long duration bonds, you do not know kya ho kya na ho, because they are also prone much more to the interest rate risks in the market. Right, so if they refinance the bonds now, right, they can avoid paying higher interest later. Right, so they can refinance the cost. So abhi like हम interest pay कर देंगे. Correct. The average outstanding T-bills bond in India is 8%. It's more than 22% in US. So the T-bond issuances have come down to by 2.5 lakh crores, right, in the past 1-2 years. Also, one more thing is, earlier the government used to give money to the state governments to spend, right? अब यहाँ spend करो, या हम आपको दे रहे हैं. But now the government only fulfills the deficit. If 100 has been given and 80 has been used, the government should only give you 80 but not 100 as a part of the new targets, right? So that process of replenishment is there, but the whole amount will not be given, like irrespective of the fact the money was spent or not. So now the government has more money and they believe that हमारे पास तो पैसा पड़ा हुआ है. Now they have stopped issuing long tenure T-bills. The quantum of T-bills has come down by 2.5 lakh crores. That is one angle of looking at the market. अब उन्हें पैसा चाहिए नहीं ज़्यादा, तो वो T-bills issue ही नहीं कर रहे हैं. So the issuance of long duration T-bills has come down and short duration T-bills are being issued to avoid the higher refinancing interest rates cost, right? तो अभी अगर मैं refinance कर रहा हूँ, right, जो 2013 के tantrum में हुआ था decide कि अभी आप कर लो refinance, right, मतलब it was more of कि long duration का refinance करो. Because short duration, I would say the cost of refinancing like every bond might be high, but now the stance has shifted. You want to refinance now at a lower interest rate and not at a higher interest rate, because the higher duration bonds tend to be more sensitive to the interest rate volatility, and hence they provide you more interest rate, more yield, and that is concept which we tend to call as a term premium, right? But now on the refinancing shall be done at a lower interest rate. So these are a couple of points upon the fiscal deficit, upon GST rationalization, problem of the twin deficit, talking about the fiscal deficit and the current account deficit, about the cess problem, about the average maturity of the government bonds, the T-bill bonds coming down, and the government having more money, right? So due to all these reasons, the fiscal deficit should come down, at least in the subsequent next 1-2 quarters. Thanks.